Thank you for joining the Unrelated Business Income Tax Training for Sertoma. Tax-exempt organizations can have taxable income. This happens when the organization carries on a trade or business regularly that is not substantially related to the charity's exempt purpose. The IRS has a very long definition of the exempt purpose of a 501c3 organization. You can find the exact language in the Sertoma bylaws under purpose. This language should also be part of the club's bylaws. If not, the club should update their bylaws. The important point is that our efforts are exempt from income tax because we proved a benefit to the community that might otherwise be an obligation of the government or society as a whole. There are 3 criteria in determining unrelated business income tax. A trade or business is an activity conducted for the production of income from selling goods or performing services with the intent to profit. Regularly conducted is determined when the trade or business is conducted frequently and with continuity, the same as comparable commercial activities of for-profit entities. Not substantially related means that the sale of the good or services does not relate directly to the exempt purpose of the organization, other than the production of funds. This is determined by the IRS on a case-by-case basis if the activities of the organization are questioned. Any interest or dividends earned by the club on savings or investments are not considered taxable, according to the IRS. The IRS has also determined there can be an exemption when substantially all the work is performed for the organization without compensation, volunteer labor. An example of this exclusion are when volunteers are paid by a business to help park cars or sell items at a commercial event or activity. Even though the club is helping with a commercial venture, the income received by the club is not considered taxable. Now that we know what unrelated business income tax is, let's go over a few examples. Rent. If a club owns a building and rents space to other businesses, whether nonprofit or for-profit, the income is considered taxable. Rental of a building is considered a trade or business that is regularly conducted and not related to the club's exempt purpose. The exemption of being performed by all volunteer laborers does not apply to rental of a building. Qualified sponsorships versus advertising. In fundraising, most clubs ask businesses to sponsor their event. In fact, this is highly encouraged. This is not considered taxable to the club as long as the sponsorship is not considered advertising in the eyes of the IRS. To be a qualified sponsorship, the business must not receive any substantial benefit other than the use or acknowledgement of the business's name, logo, or product lines. This means you can print the business logo and name in printed material, such as programs, shirts, signs, or display their product at their event. The IRS defines advertising as meeting 3 requirements. Messages contain qualitative or comparative language, price information, or indications of savings or value. 2, endorsements of the business or product. And 3, inducement for attendees of the event to purchase, sell, or use the products or services. If the club meets the advertising criteria, the income received from the business is taxable income. If the club has $1,000 or more in unrelated business income, it must file a Form 990-T with its annual 990 tax filing. If the club will no longer be able to file Form 990-N, even if the club's gross revenues are under the $50,000 income limit required for a Form 990-N. If the club expects to have $500 or more in taxes, it must pay estimated taxes quarterly. The tax is calculated based upon the prevailing corporate income tax rate. For more information, see IRS Publication 598. Thank you.